All right, welcome to financial management. This is gonna be the first lesson today, and it's gonna be pretty much based on the notes that I sent, right? The notes that I sent today and the other ones that I sent last week, which are the ratios. So we're gonna be pretty much discussing that today. So we're gonna obviously start with what we expect to be doing in this module in financial management. This is financial management. So some of you are joining us from MAC 3761 and others are joining us from MAC 3702, which is good. So, but we are both at this point doing financial management. So we're gonna grab a start and look at what this module basically entails. All right, so I'm just gonna share my screen, right, on the financial management notes. These are the ones that I sent in the group earlier. So these ones, in general, give us an overview of what your job as a financial manager is, which pretty much entails what you are learning in this module. So which is what you're gonna be doing in this module. So hopefully, after you're done with this module, you should be in a position to be adding some value to your organization. If you are a tutor like myself, you should be in a position to assist other students as well who may be struggling with this module. This is considered to be one of the giant modules that UNISA is offering. So once you do well in this module, you know that you've pretty much, gotten over a milestone, if I would put it that way. All right, so financial management, I was doing as well finance not so long ago, and we pretty much say a lot of things. Guys that are doing FIN, maybe FIN 3701, FIN, the one in particular was FIN 2603, which is very, very easy actually, which I'm sure is finance for non-finance students. Very easy. All right. So we actually share the same definition here. Financial management as a discipline seeks to optimize the financial resources of and the returns to the entity by optimizing two primary activities, namely the financing activities and the investing activities. So at the end of the day, as a financial manager, you are either overlooking something that's related with the financing activities or the investing activities, both of which are very important and both of which need to be optimized, right? Involved in. So when we talk of financing activities, we are basically dealing with, as you can see there on the note, you are basically dealing with the acquisition, right? You must forgive me because I have to keep allowing people to come in. So these particular settings actually take us to the take you guys to the waiting room. So I have to keep getting you guys in there. So what are financing activities? Financing activities are basically, where are you getting the funds, right? Where are you getting the funds? This is what we are basically looking at. Why do you need funds as an organization? Remember, when we talk of funds, we are talking about capital, right? Capital, what is capital? If you did some basic accounting, I think some years back, when we're doing the most basic accounting, you'd probably hear that capital is the money that is used to start a business, right? I think that was the most basic definition that I got of capital, money that is used to start a business. But at this point, we still do agree with that. But at the end of the day, we could say in simpler terms, to incorporate everything, it's money that is used to finance the operations of a business, right? So bear in mind that this can be long-term financing or short-term financing, of which we are gonna hear quite a lot of that anyway, much later in the module. So it can either be long-term or short-term. And again, the sources can either be from equity or from debt. So I think there's a diagram that I put up there. So we'll quickly rush to that diagram as soon as I'm done with this here. All right, so Financing activities by deciding which sources of financing, so which could either be debt or equity, right, should be used by the entity, and what is the optimal proportion for these various sources of finances, right? So in other words, where do we win most? So that's your job. You don't just go out there just because somebody's offering a loan, then you want to grab a loan, right? So you need to be prudent about it. Just because you have access to the stock market, you can't just issue shares so that you, just for the mere effect of issuing shares, right? So if a company needs, for example, 10 million to fund a certain project, say we are a university and would like to build a wall, right? Let's say we would like to build a huge wall for our graduating students, and we might need, just to pick a number, say we need 10 million rands for that. So if you are part of the financial management team, then you need to decide, okay, how are we going to fund this project? Are we gonna issue shares? And what are the advantages of issuing shares? So that is equity funding. Or are we gonna get into debt? You see, what sort of things are you gonna be taking into consideration? Okay, so that's what we are gonna be talking about, and that's what you will be doing under those circumstances. What are you taking into consideration? If you're gonna take debt, what type of debt are you gonna take? You see, what are some of the factors that you need to take into consideration there? So that's part of your job. All right, and then on the other end, what you will be doing now has got to do with investing activities. So after you've received the funds, right, you've been hired as a financial manager. Now, the shareholders have given you money, and you have 10 million in funds. What are you going to do with that money? So you don't just get funds for the sake of getting funds. You must have a purpose. You must have a purpose for those funds. If you're working for a local government, for example, you guys could be allocated some funds by the treasury. You could be allocated some funds. So what are you going to do with those funds? Are you going to fix the roads? What else can you do? Maybe sanitation. You know, there are a number of things that you can do, right? A number of things that you can. Are you going to employ cleaners? You know, so you need to come up with the right decision, something that's going to optimize your operations there in the local government, right? Why would you do that? If you look at this in the perspective of the government situation that we have now, we are fast approaching the voting season. So which means any decision that you make, they can easily be reflected on the polls, right? So you get the money and you don't fix the potholes, you know, people are likely gonna be protesting, but at the same time, you might want to give people jobs because people are gonna be complaining about employment. So there's just a lot of projects that are competing for the funds that you have. But which projects you go for, then you need to be prudent and you need to be a smart financial manager there. So that's what we are gonna be doing when we're dealing with investing activities. Then we are gonna be scrutinizing these projects and you know, putting them in order as to which one could we do first, which ones could we afford not to do. So what sort of things do you look at when you are trying to arrive at that decision? So that's what we are doing there. All right, so let me fast forward. I think we can easily get this there on right. The rest of everything here is in these notes here that I sent. All right, I think this diagram simplifies what I'm talking about here. So you see at the very top there, we have the financial strategy. So what's the financial strategy? What's your financial strategy? You want to create a long-term sustainable shareholders wealth, right? That's your main point. Why? Because remember, you must remember that as the management team, you are employed by the shareholders. You report to the shareholders. The shareholders are the owners of the company. So you report to the shareholder. So at the end of the day, every decision that you make needs to be reflected, like needs to be reflected there on the happiness of the shareholders. But before we even get to that, so what we're doing, there's what we call the capitals. I think I put it up there. If you check there on the third paragraph, where we talk about long-term sustainable value is also created by the entity optimizing, managing, and balancing the interrelated capitals other than the financial capital. So what we're dealing with here is the financial capital. So which obviously deals with the financing of the organization, of which we already say this is split into the financing activities as well as the investing activities. So you need to optimize the financial capital, but you can't do that at the expense of other capitals, right? There are 6 of them in total. So which is the human capital, the intellectual capital, manufactured capital, and natural capital, as well as the social capital. So you might want to go through the definitions of each and every one of those, just to build an understanding, just to build a brief understanding of what we're talking about in terms of those capital. Maybe you could be asked to define them, so you just need to keep yourself on the safe side there. So looking at an organization as a whole, whatever we do in the financial capital should not compromise the other capitals, because we need to be looking at this in holistic terms. I don't know if you guys have heard of the King 3 report, which talks about financial reporting. So the financial report needs to not just talk about the financial aspect of the business, but talk about all these other capitals as well. Because if an organization has to be sustainable, then we need to balance all these things. Just to give an example where we could have, say, something going wrong there. Let's say when we talk of financial capital, we already say it is financing activities and investing activities, right? Suppose now we've pretty much done well and we've acquired the right funds. Let's say we've acquired a cheap loan, which is good, and then we use that loan to manufacture a product that is probably harmful to the society. So the problem that we have there, we might be doing well on the financial aspect, in the sense that we are getting a cheap loan and we are making a huge profit. Right? We are manufacturing something and then making a huge profit out of it. Maybe we are taking shortcuts, as it were, and then making a huge profit. But the overall impact of that will have a telling, say, on the manufactured capital, because say we'll have manufactured using, for instance, something that will optimize the financial capital but compromise the manufactured capital. Let's say we are manufacturing a product and we've decided that we are going to go for cheaper raw materials, but those cheaper raw materials, on the other hand, are not going to give us a good quality product. So at the end of the day, we are making money, but at the expense of the manufactured capital, which is the product. So our product is compromised. So the overall effect now is that our sustainability is going to be compromised. So sustainability, we are looking at the long-term survival of the organization. So what if in the long run we have competitors that come and we've already built a reputation of substandard products? So we can easily be kicked off the market under those circumstances. So this is not just about finance. So hence, the questions that we get in financial management might require us to have a balanced thought process, right? To think about this from an organizational perspective as a whole, right? To have a holistic approach. Fine, we are making money out of this, but what are other considerations that we need to make there? Sometimes we could make money at the expense of, we could make a huge profit at the expense of giving our employees a raise, right? So that's obviously going to have a problem with the human capital there. So it means we are basically not treating our employees well. Another example, we could take a shortcut, and then when we talk of intellectual capital, for example, we could violate intellectual property rights. Say you are a musician, you could steal somebody else's beat, make money out of it, but the risk obviously is a lawsuit there. and a bad reputation in the long run. So we need to keep all those things balanced. So at this point, we are dealing with the financing activities, investing activities, but we need to put these things into perspective, right? Put these things into perspective. We don't look at them in isolation. All right, so the financing decision. So this is what we spoke about already. So we basically have got two sources of financing. So there is equity financing and then loan financing. So equity financing, so this we are gonna keep discussing. So most of these terms will be recurring, right, throughout the course of this module, because I mean, it is the same all the way through, right? There is equity financing and then debt financing, which is written here as loan financing. So when we talk of KE there and KD, we are basically talking about the cost of equity, and KD is the cost of debt, right? That's how we normally depict that. It's the cost of equity and the cost of debt. So what is cost of debt or cost of equity? So nobody on earth is going to give you money for free, right? Unless, of course, if but there's nothing called a free supper anyway. But in the context of financial management, whoever is investing or whoever is providing you funds as an organization is going to expect a return. So on the side, or from their perspective, which is the givers of the finance, the lenders, right? The ones that are giving you finance, which could either be equity or which could either be debt, are going to expect a return from that. So from their perspective, what you give back to them, either in the form of dividends or in the form of interest. So it's dividends if it's if you are looking at equity. So equity is much like a good example of equity would be the ordinary shareholders, right? So these ordinary shareholders are going to expect dividends, which is the monies that are distributed to them every now and then, right, in the form of dividends. I think you've come across that word before, right? So we would normally fund an organization if it's equity, and you are buying an equity instrument from an organization. You are basically going to expect to be getting dividends from that organization. So those dividends there is your return, right? You are not giving them that money for free, but you are expecting dividends. If it's debt, debt has interest, right? Debt attracts interest. So if you go to the bank now and they give you a loan, you're going to be expected to be paying some interest. So in other words, if you give an organization a loan, they are going to be getting you some. They are going to be giving you some interest. So later in the module, we're going to be discussing the advantages and disadvantages of each, right? Okay, somebody is asking me to Zoom this here. Okay, but I sent this in the group already. So, but let me just Zoom. I think it's going to be helpful if we can Zoom this for you guys to see. All right. And there you go. I think this is much better now. All right. So later we are going to be looking at we're going to be juxtaposing now equity financing and debt financing. Under what circumstances is it convenient for you to go for equity financing, and under what circumstances is it convenient for you to go for debt financing, right? From the perspective of the organization, right? I haven't seen any of these from the perspective of, I mean, in this module, from the perspective of the issuers of those funds, but maybe we can as well discuss that, right? Just so we can be visible in an exam, right? But mostly from the perspective of the organization. When does the organization benefit most? Because we are saying you want to optimize, right, your financing activity. So where are you benefiting the most when you are issuing equity, and when are you benefiting the most when you are issuing a debt instrument? All right, so sources of equity financing there, we have issued share capital. So those normally will be the ordinary shares, right? And then distributable reserves, non-distributable reserves, retained income, any form of debt that has a conversion option to ordinary shares. So we don't deal with that much here in this module, financial management. But issued share capital, this is mostly going to be the ordinary shares, right? It is mostly going to be the ordinary shares. So we are going to be dealing with that again in detail. Right? Not much detail, nothing complicated, but something that's at least relevant with what we are doing here. All right, and then distributable reserves. So every time an organization makes a profit, some of that profit is stored within the organization, right? In other words, it's not distributed. So profit is generally the earnings after you have deducted all your expenses, and you've deducted your tax, and you've deducted your dividends. So you remain with your retained income, what we call your retained income. So that retained income is basically the funds that you've not distributed, the funds that remain within the organization when all has been said in time. So instead of getting a loan, you could as well use those. So because the owners of the company are referred to as the equity shareholders or the equity funders, so hence the retained income, which is the money that remains there, still belongs to the owners of the company. Hence, it's going to be classified as equity or as part of sources of equity there. So retained income is basically that money there that is left forward, or those funds that is left over. So which means if you keep piling up those funds year 1, year 2, year 3, you might end up having a huge amount of money. I think one organization that usually hears this kind of thing is Warren Buffett's organization, right? I believe they do have quite a lot of this. So retained income and distributable reserves is pretty much similar, right? We call these ones distributable reserves because they can be distributed in the form of dividends, right? They used to call them back in the days, revenue reserves, right? Revenue reserves, in the sense that at some point in time you can decide to pay your shareholders dividends, and you can use those funds there to pay them dividends. But non-distributable reserves are a form of equity that does not arrive, or that does not mainly arise from retained income or from profit, but which is still part of, which is going to be still part of equity. A good example of this would be, let's say, a revaluation surplus, right? I don't think if you are doing accounting, I think you'll be familiar with this. A revaluation surplus, if the value of your property has gone up, say let's say your company owns a block of flats. Today they were worth $1 million. Now that there's a school next to that property, they are going to be worth, say, 1.5 million. So that increase goes to the revaluation surplus. That 500,000 increase goes to the revaluation surplus. But it's not exactly money, right? It's not exactly money. So hence it's non-distributable. You can't say we are going to be paying dividends using that amount there. That increase in the fair value of that asset, you wouldn't do that, because the money is just not available up until you make a sale, right? You sell that asset. All right, so, but more of this again later. Examples of loan financing would be your debentures, long-term loans. So the difference now between debentures and long-term loan, this, I think people who are doing monetary economics should know this again. So what happens is, with let's say you want to get a loan, a 10 million rand loan, right? But it's not easy for you to get a 10 million rand loan. Okay, let's just say $10 million, right? $10 million. You can't easily get a loan for $10 million. But suppose you have a project now, and that project requires that you get yourself into debt, right, of $10 million. How do you go about that? Where do you get that amount? So your options, or your first option, could probably be going to the bank, right? But there you go to Standard Bank, and they tell you that no, we can't just give you that amount, right? It's too risky for the bank, right? In the sense that should things go wrong, the bank is risking losing that huge amount, right, in an unprofitable investment. So if the bank decides that no, your other option that you have is this debenture loan. So under debenture loans, you basically break down that 10 million into chewable chunks, if I might say. Let's say you break it down into $1,000, $1,000. So you divide 10 million into $1,000. It's basically gonna give you a certain number, right? Which is roughly 10,000, right? Then you say you issue that as debentures, right? You say one debenture is gonna be worth 1,000 rand. So in other words, if you get yourself 10,000 people that are buying those debentures of 1,000, then you are easily on 10 million, right? So these guys are going to be sharing the risk. So if you are going to lose, how much are you going to lose as an investor? If you've just purchased one, you're just going to lose $1,000, right? Which is not much compared to the bank that's going to risk losing $10 million. So that's the reason there. So it's a lot from the perspective of the fund providers, it's a lot convenient for you to do debentures, right, than do a long-term loan, right? But at the end of the day, from our perspective, those are both loans, right? And then the other advantage again that you have with that debentures have over long-term loans is debentures can be traded, right? So I could take that debenture and let's say I purchased the debenture from the company for $1,000. So I might decide that, okay, I might decide next year that I don't want that debenture anymore. I could sell it to somebody else, right? We do that sale in the secondary market. I think we're gonna do that again when we go into detail. It's the primary markets and the secondary market. So I could sell it to my brother, let's say, for $900 or $1,100, depending on the market rates, depending on a number of other things, right? So which means you are not bound. Unlike a loan, once you've entered into a loan agreement, it's 5 years. You are not that flexible, right? But with debentures, you become flexible. So that's why that one is a lot more convenient there, right? Lease financing, say if you wanna acquire an asset, you can acquire it with lease financing, right? Like the way you would buy a car, right? The way you would buy a car nowadays. That's a very good example of lease financing. And then preference shares. So with preference shares, we're going to talk about preference shares again because there's another class of preference shares which are classified under equity. So we're going to talk about those much later when we go into much detail on the financing decisions, right? So the techniques that we're going to be dealing with here is the cost of capital and capital structure. So the topics that we're basically going to focus on here are about the cost of capital. So we need to be able to calculate the cost of the capital. So remember, our goal is to go cheap, right? But how do we know that it's cheap? Then we need to be able to calculate it so that we can determine that it's cheap. The capital structure, what is capital structure, right? So capital structure, we get that on those ratios that I sent there. All right, and then investment opportunities on the other end, capital assets. So we're gonna do quite a lot of this. Say you might wanna decide in investing. Let's say we spoke about building a wall. Maybe we could talk about building new roads and what have you. Maybe you build a road and you put a toll gate there, so you expect to get a return from that sort of thing. So those are some of the opportunities, investment opportunities. So you have money. So what options do you have? And as far as using that money is concerned, right? Replacement of assets. So you know that sometimes your assets get old in the organization and you can't, and they are not as productive as they were. So you might need to replace those assets. That's part of that. And then mergers, which we are going to do quite a lot of again, mergers and acquisitions. And then restructuring, we are not going to do that here. Right. And then valuation methods, we're basically going to be talking about this actually speaks about the criteria that we use to arrive at our decision as to, are we going to go for project A over project B? Can we do projects at the same time, etc. So that's also capital budget, investment appraisal, as some people are going to call that. All right, I don't know if we have any questions on that before I quickly go to, I want to briefly talk about the other notes that I sent there on the ratios, because we're unlikely to go back to ratios. Let me do a new share and we go to the ratios. But if you have any questions, please just interject anytime. That's my number there, by the way, that big number. So meaning you are free to contact me anytime. All right, so I'm hoping that you have gone through these ratios. So part of what we're doing today, you would typically find on these ratios, but please familiarize yourself with the major limitations of this of financial information, because we separated between financial ratios here and the non-financial ratios, and these carry a lot of marks, by the way. Both the financial, you hardly ever get an exam that doesn't have ratios, right? So what's important with ratios now is your calculation, right? For starters, you must be in a position to be able to calculate these ratios, but which is the simplest part, right? Other than that, you need to be able to analyze these ratios, right? In other words, you need to be able to bring meaning, to put it into context, right? To put the ratio into context. But how do you do that? Obviously, you need to start off by understanding what the ratio tells you, and then from there, being able to interpret the ratio in the context of the scenario that's given. So the growth rate here, I particularly put it because I know most of us here, like myself, we are old and we probably covered these things some time back. This is on basic mathematics, how to calculate the rate of growth from one period to another. This is something that was probably covered first year or in high school, right? So this is there as a reminder. And it's very important because the growth rate basically tells you whether there's an increase in something or there's a decrease there's a decrease in something, perhaps in an element. If you take, for example, on your assets, take your property, plant and equipment, for example, has it gone up or has it gone down? So you can use this ratio to see if it has gone up, by what percentage has it gone up? If it has gone down, by what percentage has it gone down? So that will help you sound smart when you're doing your analysis. Maybe you are going to be talking to someone, maybe in an interview, or maybe you are doing a presentation at work. Try and bring these things up, right? Just try by all means to bring these things up. You don't just talk about figures, right? You don't just say the property, plant and equipment was such and such an amount in 2022, 2021 it was such and such an amount. You can't just stop there. Tell us that there has been such and such percentage increase, right? Or a decrease, if it was a decrease. So that's going to add a little bit of value to your argument, right? So of course, because we are going to be looking at this in any given context, we need to look at what's happening in the industry and look at what's also happening within the organization, right? Maybe such ratios can be used maybe to assess the performance of the department. Say you're assessing, say, the performance of the sales team. How good have the sales been? Have they increased? Say you've been told that once the sales have gone up by over 10%, you guys can get an increase. Then you can use this ratio to do that there. All right, and then our ratios, of course, can be split as illustrated in these notes. So you have your profitability and performance ratios there. So these are also very important, right? Gross profit over revenue. What does it tell you? Those are the notes there. It's given. It's written there what it basically tells you. So if you're gonna be asked in a say to assess an organization or to assess an organization's profitability using ratio analysis, then you have quite, from the ones that I put here, you have three choices that you can go for. You can talk about gross profit margin, you can talk about operating profit margin or net profit margin. But most importantly, what does the ratio tell you, right? So your starting point, of course, you don't get a mark for this part. It's obviously easier if you can start off with you can start off by giving us the formula for that ratio, which is, for example, on A there, which is gross profit over revenue times 100. And then the next thing that you can give us there is the calculation that you can put in the numbers there. So you can just plug those numbers out of any of the financial statements that you're given, and then you put that there, right? And then you let us know what this ratio tells us. So this gross profit margin shows the proportion of sales that is available to cover other expenses and to earn a profit after accounting for cost of goods sold. Simple as that. And then from there, you can then comment about the organization. Is it good or bad? So it's not so easy to tell if it's good or bad, right? Up until you've compared it, maybe if it's within the same organization, you could have compared it with the previous year. Or if it's an inter-company comparison, then we are going to be looking at another company within the same industry. Then it can tell you. So obviously here, the higher the better, right? So then you can comment and say, ours is probably doing well, you know, because our rate is that compared to the industry or compared to last year. And then sometimes these questions are going to require you to talk about some of the reasons why either your ratio has been good or has been bad. So this is where, again, your understanding of the ratio comes in, right? So if the ratio is good, for example, if the gross profit over revenue ratio is good, it means that we are making a good gross profit. So under what circumstances are we making a good gross profit compared to sales? So under what circumstances can you get that scenario? So it's obviously when our cost of goods sold is minimized while our sales are maximized, right? So in other words, the gap between your sales and your cost of sales is widened, right? Because that gives you your gross profit. So when that gap is widened, it means that your gross profit over sales or over revenue is also bigger, right? So which means the circumstances under which that can be widened is when maybe your sales price has been favorable, right? Your sales price has been favorable, and or you were able to maybe negotiate for discounts with your suppliers, right? So you just look at what's the composition of your cost of sales and what's the composition of your revenue, right? So in other words, maybe you've had, you know, your marketing team has done well and they've managed to market the products that have got a very good sales value. And then on the other hand, maybe your cost of goods sold, you've managed to look for cheaper alternatives or alternative suppliers, right? That can give you the product cheaper, or you've negotiated, maybe you've had discounts, you know. So you see how important it is for you to understand those terms, what gross profit is for starters and what revenue is. What is operating profit? So I spoke about, I think there's a finance that I was doing again earlier. They were asking what operating profit is. So operating profit, I think we put it up here. This is profit after accounting for operating expenditure, but before finance cost, tax, and investment income. So which means right below your gross profit there, if you just deduct your operating costs, it's going to give you your operating profit there. So again, if this ratio is good, simply means that your operating profit is good. So what entails your operating profit? Then you can talk again about what we spoke about on your gross profit, because your gross profit is included in your operating profit. So if it's good, then something must have gone right either with your sales, something must have gone right maybe with your cost of sales, maybe your operating costs again were low. right? So if it's bad, it's obviously going to be the opposite. You are unable to sell your goods at a good price. Your operating expenses were high, or perhaps your cost of goods sold, you're purchasing from very expensive suppliers. So those are some of the reasons. But so you just go in that direction if there's nothing in the scenario that's specifically talking about that ratio there. Then you can basically go in that direction. Same with your net profit over revenue. Return on equity. What is equity? We spoke about equity not so long ago, right? So if your ratio is good, again, simply means that ideally your net profit is good. What is in your net profit? So your net profit is profit after accounting for all these other things, right? Finance cost, tax, investment income. So in other words, it is the bottom line profit, right? So that is what that one is right there. Then I need you to watch out now for the difference between your earnings before interest and tax, and which is that EBIT there, and then your operating profit. There are some circumstances where those amounts there seem to be the same, but you need to just watch out for the difference. So let's see if I put that there. Right, no, I'm gonna check. I think I put it down on some notes there. Watch our earnings before interest and tax is. All right. All right, now I'm gonna check that again, but I thought I put it because of how important it is. I actually thought I'd put it up there. The earnings before interest. This is a measure of the performance generated on all assets employed in the business and expresses earnings before interest as a percentage of the total assets. Right, the appropriate return generated on total assets to be used as the numerator is the earnings before interest and tax, as this figure includes. Okay, there we go. I put it there. This figure includes the operating profit, which is that one there that we spoke about on B. Right, let me just blow it up. Includes the operating profit and interest and other income and by those total assets, right? So which means the interest that is included here is income, right? It's gonna be interest income, but the one that is excluded there is your finance costs, right? So it's interest and other income. So this is your interest income, right? And then obviously the one that is excluded is going to be your interest expense as well as your taxation. All right, so someone is asking for the notes. Okay, I think I'm going to make sure, yes, the notes were shared in the group. Maybe you were not shared in the group, but I'm not sure. We're just gonna ask someone to reshare those notes there because we shared those ones last week. All right, so liquidity ratios. All right, what are we looking at in terms of liquidity? When you think of liquidity, think of the short-term funds within an organization, right? So when we say someone is liquid, we are talking about, think of cash. Okay, when we talk of the most liquid assets, it's cash, right? But your current assets in general are more liquid than your non-current assets. So hence your liquidity ratios are going to be dealing with your current assets there, current assets and your current liabilities, right there. So I think these ratios are going to be just straightforward there, just straightforward. And then right, let's see. All right, quite a lot of them still straightforward right there. All right, and then the financial markets. I think there was a question in the other group with regards to the financial markets. Maybe we're gonna deal with this one much later, right? Not as a topic. Not that, I mean, we shouldn't just bombard ourselves with knowledge, but just for now, you just need to understand what earnings are. For example, on A, what earnings are, how do you get the number of shares, right? Sometimes the number of shares you're gonna be the total amount of share capital, and then the value per share, the nominal value per share. You can divide, it's going to give you the number of shares. But these are very important when we talk about the financial market. Dividend per share divided by earnings per share, dividend payout ratio, dividend cover ratio, price earnings ratio. Most of these we're going to use much later. So I think as we go through examples, then we can talk about these in detail in the perspective of or in the context of a question. All right, so I'm just going to pick a question for us that we can go through probably on our next session, but I'm going to give you guys the question well in advance. Question on ratios, and then we can discuss those there, right? We can discuss the question. I don't know if you guys have any questions. You have any questions?